Hey, happy Wednesday, TraderMerlin here. Hope you had a great session. It was probably boring for most of you. If you look at the end of the day charts, just I was disappointed that I didn't get a chance to trade today, and I looked at the charts and I was like, great, I'm glad I didn't have a chance to trade it because it was just an ugly, boring day. Hopefully we'll get better. No, Bill Addis is not today. Bill Addis will be Thursday. I confirmed him yesterday, so we will be talking with Bill Addis on tomorrow's show, which is going to be pretty good. There's a ton of talk track around the repo market, now the reverse repo market, and this raise and kind of the special rate there that the Fed did in the last meeting on last Wednesday. So Bill Addis will be tomorrow's guest. Today, I'm on my own, which is okay with me. All right, the show for today is going to revolve around a question that came in, I want to say 2 days ago. And that question came in from Rich. And Rich's question is this. He says, love your show. If you get a moment, can you please clarify selling a covered call? I have some stock positions that I want to generate some income from. I can't wrap my head around what exactly happens if I sell a call on stock I own. How do I profit? When do I unload the call position? All right. It's actually very, very simple. I'm not going to go super in-depth on this. We'll keep it kind of high level, just get to the basics. But really, it is all about income generation with covered calls. Now, obviously, the first step of a covered call is you have to own some underlying security. I personally would never recommend selling a naked call. That just, to me, is one of the riskier things you can do in the options market. If you own positions, and pick whatever stock you want. You didn't mention in there what your security was that you were holding that you have that maybe I could use as an example. But whatever security you have, let's say it's Microsoft, MSFT. If you're on Microsoft and it's just sitting in your account right now, you're subject to whatever market fluctuations happen. And we'll bring up Microsoft chart here just since I threw that name out there. And you've been doing well if you've been holding Microsoft, right? It's teetering at all-time highs again. Well, if you wanted to, you could generate extra income, and what amount of income is obviously determined on market forces, volatility, etc. But you could be selling options and generating a little bit extra, or a lot extra, depending on how risky you want to get. So let's see. I'll try to come up with a basic example, and it's all about premium. Big F says premium, baby. Absolutely. So I don't sell often covered calls simply because I usually am not holding long positions in the market for a long time. I'm more of a selling cash secured puts, which basically is saying I'd like to buy something if it drops down in price. And remember, where we are right now in our current markets, we are in a strong uptrend. So for me, I'd much rather be selling puts because I'm expecting the market to drop back down, maybe into a demand level, and then continue its uptrend until that trend is no longer there. But again, back to the initial question, which was I have some positions for Rich, and he wants to generate a little bit extra income. So what I'll do, a couple different things. I'll show us the option chain, and then we'll run through examples. If you guys have a specific stock out there, I guess, just throw it out to me, and maybe we'll do the analysis on that specific security. So I will do, let's go to energy, since energy is going to be a topic of discussion because I have multiple people asking about energy. So if you look at this chart here on XLE, step back, we'll start things off with the big picture and go from the monthly, work our way down to the daily. It's ripping up. It's actually, to me, it's coming up to this $60 mark, which might be a price target for me, right? So right now it's currently trading at $54.56. So what I could do is I could, entertain the idea of, all right, I want to sell if it gets to 60, right? So we'll move this line up and put it right about there. And maybe that's my target for this bad boy, right? I'm just thinking, where might it go where I would be happy selling? And remember, when we talk about trades, and I don't think it really matters which school you go to learn about trading or investing. It's basically your three variables that you always have to think about. Your entry, your stop loss, and your price target. For me, the most important piece is your stop loss because that defines how much you are going to risk on that specific trade. Now, if you have those three variables, you've got the price you paid to get in, you got the stop loss, so you know exactly how much you're risking. The next part is just all the exciting piece, which is how much can you potentially make on that trade. So let's assume that you're already long XLE on this chart here. You're in it and you're thinking, all right, I'm targeting $60. If it gets to 60, that's the target where I would be happy selling. If you're already happy selling anyway at that price point, why not sell a call and basically collect some premium, which ensures that you are giving up those shares at $60. So by selling a call, you're basically saying, If it gets to this price, I'm happy to sell it. Now, since current price is at $54.56, selling it at 60, you'd love that, right? But you'll only get rid of your shares. So let's assume you own 100 shares, right? We got 100 shares of XLE in this example. And your target on this specific setup is 60 bucks. All right. Well, you know, and let's assume that you bought it at, I'll just say you bought it at 54. That's my entry. And your stop loss, let's call it 53. Right? So you're already in the money. You're up a little bit. You're up 56 cents. So if you wanted to get that $60 price target, and that was your objective, would you be okay selling an option right now that guaranteed you'd exit that trade at $60 if it got to $60 and a penny? Certainly you would, right? Because you already told yourself your target was 60 bucks. So what I can do is I can come over to the option chain. Let's type in XLE. All right, so there's your XLE, and it really depends on what time frame you want. The longer you go and sell the option, the more money you will get. The problem with that is, as an option seller, you want to be, think of it like selling ice cubes, right? You want to sell those ice cubes to melt as quickly as possible. And if you guys know, there's a kind of a time decay curve. Let me bring up our PowerPoint here, and I'm going to draw an example for you just so I can make sure that we get this example covered. And I'll create a new slide, and we will change that to a different slide. One second, I'm trying to get my whiteboard up here, which I need to change this screen layout. Okay, so let's go to this bad boy, and we'll go full screen on that one. Okay, so you got a blank screen right now. Let me grab my little handy-dandy drawing device, which I still don't use very much, and I'm kind of annoyed with, but oh well. There's if you go value and time being at the bottom, and value on the other axis, it looks like this. Over time, it slowly drops down, but as you get near the end of an options contract, it drops like this. So if you're selling an option, you're basically selling time. You don't want there to be a lot of time. You want to make sure that if you are selling those options, that it's going to decay as quickly as possible. If you're a buyer of options, you want to buy it, you know, somewhere over here, right, as a buyer, because you want as much time as possible for that option to come true. But as a seller, I want to get right near this big sharp curve. So we'll just go seller, and this would be a buyer over here. Right? So a seller, you're trying to buy, or buyer, you're trying to buy time. A seller, you're selling time, and you want as little time left as possible on that. So if we go back to the option chain here, you know, I could sell weeklies. I could sell tomorrow's option. You can see there's the 25th of June. So literally a day, all right? And let's say we said the 60s. So I go here, look at the 60 call. I'm not going to get anything for it, right? There's really no value in that one. Odds are it's not going to get there anyway. You could sell it, but it would probably cost you more in commission, so don't bother. Now let's go out a little bit further and get out of the weeklies, and maybe we go to the monthlies. This is 22 days out on this monthly. All right, so I go look at the $60 strike price, and I'm only going to be getting $25 extra, right? Remember, this is times 100. And since, let's assume you have 100 shares, you would only be in one contract. So you would sell this contract, and let's say you collected, I'm using the bid and ask here, it's 20 by 25 cents. You should split that, so let's say it's 22 and a half cents. That means you'd be collecting $22 extra on your 100 shares. It's not a lot. It really is not much at all. But what if you wanted to make 1%? I've told you multiple times on how I sell options every month. I'm going through and I'm selling puts and collecting 1% premium on the account. Well, if you want to do that on this specific trade, what exactly would we be looking at? So, you know, you might be getting a little bit more aggressive by getting closer to price here if you are trying to get 1% per month. So what might that look like? Let me show you. So right now, if the price was $54.45, that's this strike price right here, right? That's the at the money strike. If you went to if you wanted to make 1%, you would need to make 54.5, which would be right here. So you could sell the 58 calls, right? $58 calls on XLE and collect roughly 1% for 1 month. Mind you, this is a 22-day expiration, so if you're looking for a month, yes, I understand it's 54 cents of premium being collected here. You would actually be collecting, let's be honest, about 50 cents right here because you'd be cutting the spread. But let's say you collected 50 cents for the premium. That's roughly 1% extra in your pocket. Now, how might that work? And I haven't looked at the questions. I'll look at them just a second, guys. Here's our price chart of it. And I'll go make this line exactly $58. So I'll go 58. So for Rich, basically, if you sold this call, you'd be saying within the next 22 days, if price stays below this black line that you see, the horizontal one at $58 near the top, if it stays below that, you simply keep that premium. You keep that 50 cents worth of premium, you pocket that, and essentially that starts to lower your cost average. So if you bought it at $54, technically your average price now is going to be $53.50. So you're lowering your cost basis on this specific trade, but you've collected that premium. Now, what's the big risk to you? The big risk is, well, there's only one real risk, and that's that XLE just falls apart and craters and just continues to fall. Because you don't have any downside protection here. You've only said, I have upside protection. If, for some reason, over the next 22 days, XLE rallies up and let's say it hits 75 bucks, and you're like, man, yeah, I get to sell it for 75. No. By selling this option contract, you have obligated yourself to sell it at $58. So anything above 58, it could jump to $60,000 a share. You're only going to get out at 58 bucks. But remember, the person who bought that call from you believes it's going to be going up in value. So that's the big difference here. So I know it was a very quick, brief, simple example, but this is how you would be using calls or selling covered calls to generate extra income. Now, I know I got a whole bunch of comments to come through here. If you personally sell a cash secured put and get exercise, would you then try it as a cover? Yes. Great question, Les. Yes, I've done that as well, where I've been executed on something. So let me change this example, right? I'm going to just do it right here. Let's go. So here's your price chart, and you can see that there's a demand zone for me that's roughly 48.50 on this price chart, right? You guys can see that. So let's say I was looking to buy XLE, and I thought maybe that 48.50 be a good price point for me to buy at. Great. Well, I don't want to do the I don't want to do the capital outlay right now, right? I don't want to shell out $54,000 or $5,400 to buy 100 shares. I could go out there and sell a put, collect some premium, and if it gets down here to 48.50, then I would own that security. So, what does that look like? Well, if we look over at the option chain again, this is again still for the 22 days out. If I look at the 48.50s, it's really not going to generate me much. You see it's between 9 and 21 cents, so that's probably an average of about 13 cents. 13 cents times 100, it's going to make me 13 bucks. It's really not much, right? I don't really feel like I'm collecting a lot of premium there. But in that example, if we did get executed and I now owned it at 48.50, it would be 13 cents less than that. So it would be 48.37, correct? Yeah, I'm just getting my math right. 48.37 would be my average price there because I would have taken out the premium that I collected for selling that put. Then if I was executed, then I would do the same process we just looked here with XLE for Rich, which is sell that call because I now would be owning those shares of XLE. I could now sell that call and generate some income, expecting price to move higher and higher and higher. Yeah, potentially the wheel strategy. I'm not too versed on that one. I see it all the time, but not really my thing. Selling covered calls and range-bound assets is the key. Yes. Well, it's two things. You know, I actually helped a friend of mine out. He had a pretty sizable position, and he's like, look, I'd love to get out at this specific price. I said, well, okay, let's sell some covered calls for you. And for about 4 months, we sold covered calls, collecting nice chunks of premium, and it never closed above there. And then all of a sudden, the next month, it ripped through, and he got out, and he was happy because for 4 months, he collected some extra premium. In a range-bound market, it's awesome, right? This is why, you know, you graduate from selling calls or selling puts to spread trading, which is a combination of calls and puts where you identify a range and you play that range. If you had the feeling, and let's say you were looking at XLE, or for Rich who asked the question, if you're looking at XLE or something, you know, if you found that there was a ceiling at $60 and it just repeatedly kept hitting its head there and you owned XLE, well, then you sell your options, your call options at 61 because you're sure that it's going to stay in that range, right? You've looked at the historical price chart. It stayed within that range. So why not collect some extra premium? Or you could also be very aggressive. That's selling out of the money. You could also sell in the money calls, which might not be the best thing. But let's say, for example, let's go back here. Let's say, for example, you thought that XLE was headed for a big decline, and you're like, oh, you know what? I just want to get out. All right, well, at what price? So maybe you thought that $50 mark was where you think it's going to drop to. It's at $54.56 right now. You could go out and sell an in-the-money call. I personally wouldn't do it, but you could. Right now, you'd be collecting, if you sold the 50, looks to be right around $5 worth of premium. So if you sold that $5 worth of premium, right, you can see here that $50, I'm splitting this bid and ask here. If you were to split that and collect $5, notice where it is on the price chart. You'd basically make yourself 50 cents more because it's $54.56 currently. You'd sold the 50s, but collected $5. So you actually would be having made an extra 50 cents on that trade by collecting more premium. I don't do that. I sell out of the money, but if you wanted to, you could potentially go in the money, but there's some risks associated with that. Personally, I would short at 60, but not an options trader myself. Well, that's perfect. And I'm glad you mentioned that, Jerry. This is why I think options are probably the most powerful asset class out there. There's so much they can do. They get challenging because it's a new language, right? Instead of going long or short, I now have multiple variables. I could be buying a put. I could be selling a call. I could be buying a put, selling a put, or selling a call and buying a call. There's 4 different real main strategies to it, and different risks associated with each. One of them comes with an obligation where you commit yourself to something. The other gives you the right but not the obligation. So it can be a little confusing. But let's assume that you wanted to go short, right? Jerry says, personally, I would short at $60, but not an options trader myself. Well, what if we did that? So we'll go up here and I'll change this number to 60. Okay, and I'll go zoom out a little bit here. So let's say you thought that $60 mark was a great place to go short. You could, right now, be buying puts at that level. All right, you could be buying puts at 60. Well, that obviously would cost because it's currently much lower than that. So if you bought the 60s, you'd be saying, I would like to sell it, I would like to short it at 60. Well, that's going to cost you a bunch of money because it's currently $5.50 lower than that, right? So it'd be a little bit difficult to do it that way. But if price does get to 60 and is at 60, you could go and sell options at that point. Obviously, when it's at $60, the premium would be a lot less than it would be when it's at $54 to buy that put. So utilizing options are great because, Jerry, if you went and tried to short XLE, let's say you did 100 shares, you have to come up with $6,000 to short 100 shares of it. If it got up to 60, no telling what the premium would be at that point, but I could go out and buy the 60 or the 50 or the 54, dollar put at a much lower value. I can spend a lot less money with the options. So what's interesting about that is your rate of return can be significantly higher with options because of the leverage involved in the back end. Greeks takes one to... Yes, it's all Greek to me, right? Well, one thing I would encourage you, Jerry, is check it out. I think options, you might find yourself really loving options, especially. I love it I like to think of myself, again, as that ice cube salesman. And when I'm selling these puts, I'm doing them generally for 30 days or less. And my whole plan is, at the end of those 30 days, and when those options expire, I want them to expire worthless. I have no interest in actually owning those shares. If I do, okay, I'll deal with it. But I would much rather have those options expire worthless, and I just simply collect premium on top of whatever the price movement of that security does. So that to me is one great strategy. I love the naked put side of things because you can go so far out of the money. I was telling you about some of the AMC ones that the amount of options premium that was available on AMC was ridiculous. It was like 4% for a week. Imagine what you get for a month. I just didn't want to lock myself up for a month. I haven't even looked at AMC recently. It's probably still up there. Oh, yeah. Here's your daily of AMC, still at $58.30. All right, just for fun, let's go see what AMC is selling for. Now, again, if you guys decide to go look at AMC, be very careful. This thing is so volatile. It's dangerous. Okay. So apparently my my software decided to crash. Gotta love TradeStation. If you want to know how an application crashes, just get TradeStation. Crashes all the time. Let me reopen this and see if that actually helps it. But yeah, I would love to learn it, for crying out loud. I'm trying a little bit, Tibor. I do it very basic here. I don't like to give away stuff from the classes, obviously. I might get in trouble for some of that. So here's my option chain again. Let's go back to AMC. Perfect. Okay, so AMC Entertainment. And we just looked at that price chart. It's trading at $58.30. So here is, let's do just for next Friday. Okay, next Friday. So $58.30. To make 1%, it's not as good as it was before. You'd have to sell a put that's somewhere around 56, 55, somewhere in that ballpark. Not very good. But you could go way out of the money here. Like I was selling 50% lower. Unfortunately, the implied volatility has dropped a bunch on this, so it's no longer as lucrative. But it was considerably higher. So I think when it was at 60, I sold the 30s. And I got 4% in 1 week on that option trade. And with this, you kind of have to be dangerous there, or you have to be careful, because could AMC go from $57 down to $28.50? Absolutely. It could happen very, very quick. Therefore, you got to be careful with that one. But $28, you'd still be collecting some premium here. You get a little bit, but not as much. And I know one strategy a lot of people like to employ is they're looking for the really high implied volatility stocks and selling puts there. Again, you got to be careful with that one and understand that if you are selling puts, you're always at the risk of potentially owning those shares. And, did I really want to own AMC at $30? Not really, which is why I went with that short-term 1 week option. I could go out much further and be collecting a lot more premium, but a little bit of more complicated to do all that. All right, what do I got here? You can also do a bear call spread at 60 if IV is high. And I think the key, Mario, is implied volatility has got to be high. When you look at a lot of the guys that I know personally who are really big option sellers and really good at it, when times showed lack of volatility or implied volatility was very low, they were twiddling their thumbs, bored and fine, forcing trades to happen. When implied volatility is really high, obviously that's when you want to be a seller of options. If it's really low, you'd be looking to be a buyer of options. So it's that trade-off out there. I obviously would prefer to be a seller because I'm collecting premium, getting paid to take some risk. I can do it. Nice. It says I love options now more than any other asset class. It's definitely an integral part of mine, although I only do really basic stuff. I do not go complex or have advanced strategies, because I'm lazy. All right, on to TradingView. Crashes so often I think it's operated by the DMV. TradeStation crashes me all the time. I fix it. I just stopped using TradeStation. Yeah, you know what? I'm about to. They've been kind of playing hardball with me with regards to fees on my account, so I'll probably stop using TradeStation. I've used them for so long, and I love the charting. I think it's some of the best charting out there, but we'll have to move. Let's see what else. I now use CliK for analysis and place trades on TradeStation web platform, much more stable. Yeah, CliK actually, from an analysis perspective, is awesome. CliK is great with what it does. It has so much features and functionality you can't get anywhere else, which is pretty impressive to me. Good thing you don't use the software on airplanes. Oh, yeah. Right, Michael? Yeah, let's not talk about Boeing Supermax and their software issues, right? All right. So, for Rich, that's it. If you got positions, look at those positions. Think to yourself, where would I like to get out? And don't be unrealistic, right? If you own a stock that's trading at $50, you're like, I want to get out when it hits 400. Okay, well, then forget about it. It's about having a realistic price target and saying, okay, if I bought it at 50, is that $55 my target? Is it 60? Is it 80? Where is it? And then what is the premium that you might get paid to sell it and get rid of it at those levels? You're just basically committing to sell and locking in that sell price. And if it never gets there, Great, you keep selling and keep collecting premium over and over and over again. The whole time you're lowering your cost basis for that trade that you purchase. Do I sell puts and calls against leaps? No. Well, puts and calls, leaps are options. They're just much longer term ones. You could sell long-term leaps. You could sell them if you want, right? There's markets for those. So if you look here, we are not AMC. Well, AMC, this ought to be interesting. Let's see what AMC stock is looking to trade at on the 20th of January in 2023. So getting close to 2 years out on AMC. Let's see. If you wanted to sell the puts, wow, look how much premium you collect on that thing. Holy cow. Pretty sure it's not going to be where at $55. You can look at the premium on this. You'd collect $31 worth of premium if you sold an at-the-money put today. And that's basically saying that AMC would be $55 in 2 years. You would collect $31.50, actually $32 worth of premium on 100 shares. That's $3,200 per option that you sold. That's pretty impressive. I guess you have to ask yourself, what does this mean to you? If you sold this leap right now, right? You had a $55 leap, strike price, excuse me, and you're basically saying that on the 20th of January, 2023, sorry, I'm writing things down so I get my numbers straight. You sold that right now. You sold the 55 and you collected, let's call it $32 of premium. For a question for the audience out there is, if it does continue to fall and fall and fall, what price would it have to get to for you to break even? If you sold the $55 strike and you collected $32 worth of premium, at what price would be your break even at that point? Anybody out there want to take a stab at that one? It's fairly simple. You would take $55 and subtract the premium that you paid. That basically means that if AMC got down to $23, then you would start to lose money. Well, I don't know if I would call that crazy. Because you look here at the historical chart of AMC, it's been slowly drifting up. Obviously, it went nuts right here starting in May 24th. This is the daily, May 24th. That's when it really started to go nuts. If you go, yep, Big Eb's got it. It's $23. If you go to a weekly on this one, 23 doesn't seem that out of line. But again, you're just taking a ton of risk. You would be collecting a lot of premium here and committing yourself. So if you sold this put at $55, what basically you'd be doing is you'd be tying up $5,500 worth of capital, right? It's $55 a share. You times that by $100 or 100 because you're buying 100 shares. That's $5,500 of capital that would be tied up in your account. Now, you would have collected this $32 worth of premium, and if by the time of expiration AMC was below $55, you would own it. You would own it at whatever price, right? Actually, you would own it long at 55, and you'd have that $32 for the premium. So that's definitely a risky thing to do. I would be much more comfortable doing that than let's see what GME is doing, right? This is one I wouldn't touch because you guys know my thinking on it. I think GME is just doomed. But here's GameStop, trading at 219. Let's go to the longest time frame that it has. And it's currently trading at 219. You guys can see the chart there. And then we'll go and look at the 210. So right now you could be collecting, it'd have to drop 50% from current levels for you to be out of money. You can see right now the spread on this is 102 by 120. You figure you'd split the difference and get in there about 110. So you collect 110. Wow, that's a lot. That's $10,000 for the premium. But remember, you're tying yourself up to $21,000 worth of capital. But you're collecting $10,000 worth of premium. Now, if this thing continues to rally, and who knows, in 2 years it's up over 300, well, you don't own the stock, but you keep the premium. That's it. All right. Those are getting a little bit crazy and probably things I wouldn't get involved with. All right, let me get some other stuff here. That was a long-winded explanation and going into examples of options for Rich, who was the initial question bringer on that one. So Rich, hopefully that explained the basics of it. Again, I didn't want to go too in-depth on that, on generating income with covered calls, especially for, I equate it to what's going on with my cryptocurrencies. So for example, obviously cryptocurrency has been getting slaughtered recently. I have almost all my cryptocurrencies are on different exchanges or wallets where I'm getting a rate of return. So for example, Polkadot. I've got Polkadot sitting over at Kraken and I'm getting 12% rate of return on my Polkadot. Most of us, most Americans, most people around the world are simply keeping their shares with a brokerage firm, your Schwab's, your E-Trades, Ameritrades, whatever, and you're not doing anything with that. But by utilizing options, and you can go further out of the money so you don't have to worry about giving up your shares or being executed, you can generate an extra amount of income. It doesn't have to be 1% a month. Maybe it's an extra 1% per year. Compounding over time, that obviously has a pretty big impact. And you could take a very little risk in getting 1% extra a year by selling premium. I obviously go for a little bit more than that, but you don't have to be overly risky like I have been a few times. Okay. Oh, Batista said you come from the future, don't buy those options. Why? What do you think's going to happen with GameStop in the future? You think that they're going to be $300? I'll take that bet. If anyone wants to take that bet, I will take the bet that in 2 years GameStop will not be a $300 company. No way. Forget it. All right, let's go to some other questions here so I can get out of here. Lee said, XLE analysis, please. Okay, why don't we look at XLE? Been pretty impressive lately, and I'm looking at this one. Oh, yeah, Jerry. So that news, I don't know if that's fake or not. I heard something that was fake news as well, but you never know nowadays. But yes, John McAfee, the crazy guy who started McAfee Antivirus and just very outspoken sociopath. He's absolutely crazy. Apparently they found him hung in prison, which is interesting because I believe it was December of 2020, he tweeted out something. He says, yeah, if you ever find me swinging in my cell, I didn't do it a la, it wasn't done, I didn't do it myself, a la Jeffrey Epstein, which is kind of interesting that he said that. You guys know, I'll take guesses. Does anybody, if he did in fact commit suicide in his cell, anybody have any thoughts on why he may have done that? I have one. I have a very strong thought on if he did, why he would have done it. I'll give you guys a second to type in the chat here why you think he might have done it. I mean, the guy has tons and tons of money. He's rich beyond belief. He can pretty much do whatever he wants. Obviously, there was some legal stuff where he was potentially going to be extradited to the United States to stand trial for tax evasion. Okay, great. Oh, Zero Hedge did confirm it? Well, I hope not. I kind of enjoyed watching him. But here's the reason why. You might recall back in 2017, I believe it was July 17th, 2017, John McAfee got in a little discussion with some people online in a Twitter feed, and he said, if Bitcoin is not $500,000 in 3 years, which would have been July 17th of 2020, that he would eat his own, how do I put this in BPC, genitalia on live television. So he probably had to weigh those options of, I have to eat this on live TV, I'm just going to hang myself in my cell. No. Yes, let's see if there is an investigation on that one. I definitely like to see it. Anyway, rest in peace, Mr. McAfee, if it is in fact true. All right, XLE. So here's your XLE chart on a weekly. Looks great, coming up into some overhead supply. We already talked about this one going on, coming up in that supply, and I agree with Jerry. I think that if you look at that $60 mark, that's certainly an area where it has had some issues, and it's revisiting for the first time in a long time. So I would expect this to stall there. That said, energy looks good, and energy tends to do well in inflationary environments. I'm not pessimistic on energy in any way. So it would certainly be a short-lived trade, meaning I'm not expecting this to be a long duration trade. So maybe as it comes into 60, you buy a 90-day put option and let it drop a little bit and then bail on those put options, obviously not expecting it to drop significantly. And you look at this price chart here, it's not like if I see XLE hit $60 that I expect it to drop back down to 25. Not at all. Look at the uptrend starting from October. Higher highs, higher lows, higher highs, higher lows, higher lows. That trend is intact. What we have right now is a challenge for XLE and getting above these most recent highs we established over the last couple of weeks. You get above that, and yeah, I think $60 is a very logical price target. I'll let you know if it gets there, if I do decide to buy some puts on it. I'm a little skeptical because it is so strong, and I believe that energy is going to continue to run. Watching the gas pump prices continue to soar is just driving me crazy. All right, luckily, hopefully I get those electric bikes coming from China here soon. I ordered 5 electric bikes. I found just the most epic deal, and I'm hoping that I can get delivery on these things because electric bikes here in SoCal they're fun. All right, last question, unless you guys have some that you want to type into chat. Rich, I think you sent this one in too. You've been asking me all kinds of questions, buddy. I got to get diversity. You guys need to ask me some questions. This was from Rich. It says, thoughts on airline stocks, specifically United, UAL, I think is the ticker symbol. Let me look up UAL. First off, with regards to airline stocks, right now, we're coming into the summer months, and I know that there's some issues with some airlines. I know that American had to ground some. I know Southwest had some issues. But overall, I'm pretty bullish on the airlines as we speak. Why? First off, they got tons of money for bailouts, so that carried them through all this stuff. Now, all of a sudden, you have not only 300 plus million Americans that have been stuck in their homes grounded, now all of a sudden we're seeing mask restrictions and travel restrictions lifted, and to top that all off, we have one of the highest savings rates we've ever had in the history of America, which basically says people have been saving money. Right now, people are going, I am going somewhere, damn it. I don't care where I'm going, I'm going. And airline prices have gone sky high. We're seeing those things soar. So I have a feeling that over the next few months, next couple earnings seasons for airlines, they'll probably post some pretty robust numbers. And my guess is that would continue some uptrends. Now, you specifically asked about United Airlines. Right now, it's showing a little bit of weakness, although overall, it's strong, right? There's no arguing that the lows we saw in early 2020 have been made. We double bottomed again here on the second tap that you saw going back into May of 2020. From there, again, higher highs, higher lows. What you're seeing now is a little bit of compression. For me, this is just simply a pause. This is where the markets take a little bit of a breather and say, okay, let me see where we're going. And, if we cut through the bodies here, that's your uptrend line, and you can go somewhere roughly through here. And you notice I'm usually I try to connect all the bodies when I go through trend lines like this. This is a pennant formation, a symmetrical triangle, as some will call it. And really, to me, it just looks like it's just building strength. It's just a pause after this really nice run up that it's had. I'm bullish on UAL. You could look at some other ones. Let's go to American Airlines. Here's AAL. A similar picture, although it doesn't have as sharp of a symmetrical triangle. But again, it's been breaking highs, coming back into demand zones, and taking off again. Love Southwest Airlines. This one I'm a little surprising on. This is one of my favorite airlines, Southwest, and you can see that it's been one of the best during this whole pandemic thing. All of a sudden, starting to show pretty big weakness, and obviously they had some major issues over the last week or so, potentially selling off more and more and more. Right now, I'm looking at this area off to the left, and I don't really see anything that should stop this until it gets to about 5150, which would be a crazy number, but I'm dumb. Thanks, folks. I'm here all day. 5150 is kind of that target for it. I'll put the line on there and leave it at 5150. But that one, it looks much weaker because it's actually starting to make new lows, whereas United and American have not. You look at something like Jets, which is the ETF for the U.S. global jets. Similar picture, although it looks a little bit weaker, right? It kind of feels like it's been bouncing along this bottom line here, which has been there in place for 3 months now, right around call it $25. We're at $25.35, and the highs have been getting lower and lower and lower over those past 3 months. So this is showing a little bit of weakness. I think out of all of them, United would probably be the strongest one that I'd be looking at. Yep, there Jimmy says the ETF Jets. Yes, that's it right there. Where do you see Tilray going? Oh, would I be cheesy if I said up in smoke? I'm just kidding. TLRY. Oh, God. These charts on these cannabis stocks are just brutal. If you look at this, it feels like it's curling back up, right? And it's simply because we've had this pronounced downtrend. All of a sudden, it made a new high, which is a reassuring piece for anybody who was bullish on this one. But now we're retesting. If we get anywhere below these lows, you're going to continue to drift down. But if it holds here and we do see it curl back up, yeah, I think you could be challenging those $22 price points that we established just a couple weeks ago on Tilray. I'm not looking at any of the fundamentals, just purely what's going on with price. But this last little rally up and sell-off is pretty important for the trend of Tilray. If it can get a footing here at these current levels and move up a bit and maybe break this 22 and get higher than that, then I think you got a nice little run potentially here for Tilray, or maybe even the whole sector. Because there's Tilray and there's MJ, which is doing something similar, right? It broke above those, made a new high, but it's come back down and kind of retested those lows. We've drew the zone on here on MJ between 1834 and 1957 as just kind of a loose zone, and it almost came back and tested it on Monday, but so far so good. All right, what else do I got for you? I'm going to go and look at some economic stuff here as I wrap up. Now today, pretty big manufacturing day, and again, we've heard so much from Powell last week talking about how robust our markets are, the job market's great and getting better, blah, 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 blah. You look at some of the economic announcements, it doesn't really paint that same picture. If I look down here near the bottom, there's the U.S. data that came out today. Flash manufacturing actually beat expectations. That was good, but services dropped considerably. You also had new home sales. This was an interesting one. We've been talking about Toll Brothers and Lennar and kind of keeping an eye on those. New home sales were expected to go from 817 up to 864. So they were thinking there'd be a big jump. Well, went the opposite direction. Not only did we not increase by 50,000, we dropped by about 50,000. So that was not a good piece as economic data goes. For the rest of the world, you can see up here, French, Germany, and the European Union all came out with manufacturing numbers, as well as the UK. Most of those were worse than expected. You can see here that the UK was worse than expected. The European Union actually was better than expected for both accounts. So not too shabby there. U.S. is the one that has me a little bit concerned. As far as earnings, you've got Steelcase, KB Home today. They reported earnings. Again, that's off that home builder number, right? KBH, I'll bring up the stock price for you. It has been struggling a little bit over the past couple of months. Since about May 1st, been in a nice little downtrend here. I'll zoom out a little bit more so you can see the bigger picture. Definitely due for a pullback, but when we talk about trends breaking, you've broken the uptrend here. Right, this thing is now making lower highs and lower lows, so this might be that reversal point for KB Homes. And remember, when we looked at the crash of 2008, home builders sold off about 2 years before that. Late 2005, 2006 is when home builders really started to dive. Housing market still rallied for a little bit, but then it came crashing down. So something we'll keep an eye on. Winnebago also reported earnings today. They blew out earnings, had great earnings, and they were down. And I think this has a lot to do with things opening back up and just be more free to move out the country with airplanes. So maybe Winnebago's sales are going to slow because they were doing great for a little while. Here's what we have cooking for tomorrow. Really the big stuff is happening at 5:30 in the morning. That's GDP numbers for the U.S., unemployment claims, durable goods orders, final GDP price index, goods trade balance, and preliminary wholesale inventories coming out for the U.S. You notice at 1:30, I should have highlighted that too at the bottom. So 1:30 p.m. Pacific time tomorrow is a bank stress test. That's after the market closes, which is probably a good thing. I'm curious to see what the results of the stress test are. The primary reason why I'm thinking that this is not going to bode well for the markets is you've had reserve requirements at zero, which means banks aren't required to save anything. So the issue of them being maybe over leveraged, I think, might rear its head. And what this could potentially do is could potentially have the Fed at the next meeting or next beige book talk maybe talking about raising reserve requirements, which is one thing that they can do to rein in inflation and require banks to have more money saved for customers as a percentage of their deposits. That, to me, will be part of the talk track going on next week. It will be the results of these stress tests. And does that mean that these reserve requirements are potentially going to start to go up to fight inflation and to maybe have a little bit more security blanket around these financial firms who are over leveraged? All right. And lastly, for earnings for tomorrow, FedEx, Nike, BlackBerry, Rite Aid, Cinex, and Accenture reporting earnings. Most of those coming after market close. After market, you got FedEx, Nike, and BlackBerry, as well as Cinex. And then before market opens, Accenture and Rite Aid reporting earnings tomorrow. Tibor says, got into gold today. Yeah, I was a little disappointed. It started off looking really good on gold's chart today and then gave up a lot of profits on it. So I am still long gold, still holding my call options on GC. But I really kind of expecting that gap to close there, that real long one, but we'll have to wait and see how that all pans out. All right, that's going to do it for me for today. If you love Bill Addis as I do and you want to know specific things about bond markets, repo markets, interest rates, yields, tips, strips, swips, dips. No, that's not a strip club. That's actually tips are actually something, and strips are actually treasury products. Let me know what it is you would like me to ask Bill Addis. We have some things I already talked to him about that we're going to discuss on tomorrow's show. Certainly talking about the repo market. You can always email me at TraderMerlin@gmail.com to get more information or send me questions, comments, feedback, whatever you'd like to talk about. And hopefully we'll get to all that with Bill Addis tomorrow. What effect do you think that will have on the bank stocks? I think it could send them down a little bit. It really depends on who comes out with bad stress test results. In my mind, I just keep thinking that part of the stress test is to see how safe they are. And if banks are in fact at 0% reserve requirements and lending out everything, that tells me that they're not going to have a lot of money as a safety net here, which that's the reason you're supposed to have reserve requirements, right? It's basically leverage. It's fractional reserve banking. So to me, it's a little bit wary about their reserve requirements and the issues there. So to me, if they start to raise reserve requirements, that means banks can lend out less money, which means what? Their share prices are going to fall because they make money from lending. So that's what happened. Just my 2 cents. Not construed as financial advice, but that's my idea of how this is all going to come into play. All right, that'll do it for me. Bill Addis again is a guest tomorrow. If there's something you want me to talk about, feedback, whatever, you can hit that subscribe button to know about the show. Send me questions at TraderMerlin@gmail.com, and I'll see you all mañana. Take care.